What if the Federal Reserve is preparing to hit the panic button? Emergency announcements, drastic rate cuts, economic shocks that could ripple through your savings, your job, and your future. The signs are already here, and they're louder than ever. In this video, we're diving deep into what's really going on behind closed doors at the Federal Reserve. You'll understand why sudden announcements may be coming, what high inflation and interest rates are doing to your wallet, and how these changes could lead to a massive shift in the economy. Stick around, because what happens next could directly impact your finances. Welcome to Financial Area, your go-to source for economic insight and financial updates. If you find this video helpful, don't forget to hit that like button and subscribe for more content that keeps you informed and financially prepared. The Federal Reserve usually sticks to a fixed schedule when making announcements, but sometimes they break that pattern. And when they do, it's a sign that something serious is unfolding. In 2025, we could see emergency Fed announcements outside their regular meetings. That may sound like a technicality, but it's actually a massive red flag. When the Fed moves off schedule, it often means the economic data has taken a sharp turn, too sharp to wait. It could be inflation that's climbing faster than expected, or it could be a sudden drop in key indicators like employment, consumer spending, or GDP growth. Whatever the cause, emergency decisions signal urgency, and urgency means risk. Financial markets react instantly to these moves. Stock prices swing. Bond yields shift. Mortgage rates change within hours. And everyday Americans feel the ripple effects in ways that are immediate and personal, whether they're applying for a loan, running a business, or just trying to keep up with the cost of living. Behind the scenes, there's growing pressure on the Fed to act. While public statements remain cautious, insiders and financial analysts are watching closely. And some believe the Fed is already preparing for a rapid response if current trends continue. That includes the possibility of large, sudden rate cuts meant to stimulate a slowing economy. The question is, what's driving this potential crisis? Inflation remains a stubborn challenge. Even though official reports suggest inflation is cooling, the lived experience for many Americans tells a different story. Grocery bills are still high. Gas prices are unpredictable. Rent continues to climb. And healthcare costs aren't slowing down. Meanwhile, interest rates have remained elevated. The Fed has kept them high in an effort to control inflation, but that strategy comes at a cost. Borrowing money is more expensive than it has been in over 2 decades. Mortgages, car loans, credit cards, all of them are draining more cash from families and businesses. For small business owners, high interest rates are a double-edged sword. On one hand, they face rising costs. On the other, they struggle to access the affordable credit they need to grow, or even survive. Expansion plans are on hold. Hiring slows down. Some businesses are forced to cut back or close altogether. Consumers, too, are pulling back. Spending is declining. People are saving more out of fear. Retailers are seeing softer demand. The housing market is cooling. Car sales are slowing. These are all signs that the economy is losing steam. If this pattern continues, we may be heading toward a recession. The Fed is walking a tightrope, balancing the need to control inflation without causing a full-blown economic contraction. But if high rates persist, the risk of a major downturn becomes very real. Early indicators are already flashing warnings. Productivity is dipping, unemployment is creeping up in certain sectors, and GDP growth is starting to stall. If the Fed begins cutting interest rates aggressively, don't be quick to celebrate. Rate cuts are not always good news. In fact, they're often a sign that something is wrong. The Fed only slashes rates when it sees serious problems ahead, problems that require immediate intervention to prevent further decline. Lower interest rates do make borrowing easier, and they can help stimulate investment and spending. But they also signal that the economy is too weak to sustain high rates, an admission that trouble has already taken hold. Alongside rate cuts, we may also see government intervention in the form of stimulus packages. These could include direct payments to households, tax relief, or targeted aid to struggling industries. While these measures can provide short-term relief, they're also an indicator that policymakers are responding to economic distress, not prosperity. This is why it's so important to keep an eye on economic indicators, inflation reports, employment numbers, retail sales, consumer confidence. The Fed doesn't act on hunches, it acts on data. And that data is available to all of us if we know what to look for. Understanding these signals can help you anticipate changes before they happen. It can help you make smarter decisions about saving, investing, and spending. And it can give you a clearer picture of where the economy is headed in 2025 and beyond. So what's the bottom line? If the Federal Reserve starts making emergency announcements, cutting rates, or coordinating with the government on stimulus packages, it means we're entering a new and potentially dangerous phase of the economic cycle. Whether that leads to recovery or deeper recession will depend on how quickly these challenges are addressed. That's why staying informed is more important than ever.